You're about to join Niels Kaastrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Alan Dunne and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. If you're new to the show, I hope that today's episode will trigger your curiosity enough to check out the back catalog and listen to the past episodes that you may have missed, like last week's episode with Jerry, where he shared his perspective on CTA replication strategies, Cliff Asness' latest article, and also re-engaged on the topic of whether trend following really is the perfect portfolio. Also, I would like to encourage you to listen to the midweek episode where actually Alan, who's here today, had a great conversation with Jason Moreau, who is the Deputy CIO at Utah's retirement system, on the challenges of managing in excess of $50 billion in today's environment, a wide-ranging conversation that I'm sure you will enjoy. Alan, great to be back with you this week. How are things? How are things in Dublin?
Yeah, good, Niels. Good to be back. It's a bit wet and dreary in Dublin. It seems like the summer might be fading away, but that aside, there's an awful lot to talk about in markets. So looking forward to our discussion this morning. How are you?
Yeah, I'm doing well. And it's certainly, as you rightly say, it hasn't been a dull summer for the financial markets. In fact, it doesn't feel like it's been a summer holiday at all, if you ask me. So yeah, we got some great topics as usual lined up, which we'll get into in a few minutes. Before that, let me quickly round up this week. We saw, of course, a slightly stronger than expected growth number in the August payrolls, but that didn't prove to be any help for stocks. Both the S&P and the Nasdaq each lost a bit on the day, actually on yesterday, Friday, and lost about 2.5% and 3.1% respectively for the week. Bonds were also under pressure this week, as were most markets across even a diversified portfolio, perhaps with the exception of the US dollar. And for those who trade orange juice actually had a good week. So those were the exceptions. Economic data this week offered a reprieve for the recent trend of weak indicators. Economists had been looking for the economy to add about 298,000 jobs in August, and that was following a very strong month of 528,000 in July. And then many analysts, of course, had been somewhat skeptical that August would follow with an above-trend outcome, but they were all proved wrong because we got a print of 315,000 new jobs. Ironically, bond prices actually rallied across the curve on this news. And maybe it's the case of sell the rumor, buy the fact. Early in the week, there had been some whispering of an outsized employment report, and in anticipation for that, market participants sort of sold the 2 years and got the yield up to about 3.5%, and the 30-year topped out around 3.36% this week. But since we're now in September, maybe I should mention that QT will increase to 95 billion, I think it is, per month now in Treasury and mortgage-backed securities, rolling off the Fed balance sheet. At least that's what they announced. QT, of course, began back in June. Arguably, it has been, quite lagging in its effect officially. It should be around 47.5 billion per month. Now it's up to 95 billion per month. So maybe we will feel the impact of that. Maybe that's part of the pain that the Fed chairman talked about from Jackson Hole. Of course, investors will be watching for signs of this operation pushing interest rates higher. And it is, of course, important to remember that we still see quite a lot of liquidity in the system, even at this stage. Maybe as usual, Alan, I could ask you a little bit what you have been sort of picking up on your radar the last few weeks since you were last on.
Yeah, it's interesting. I think when we were last on, we were talking about the market had concluded that we were possibly at peak inflation and peak central bank hawkishness. And, since I think it's about a month since I was on, you had a lower inflation print in the US that gave people a bit more hope on that front. But then obviously a whole raft of comments from Jackson Hole and subsequent to that would suggest that the view that we're at peak central bank hawkishness was premature, I would say. So even looking at the markets yesterday, it was probably for anybody looking for some good news, you could definitely find positive aspects to the employment report. The participation ratio jumped up, and average earnings were more moderate. So certainly you could find something positive if you were looking for peak inflation there. But it does kind of underscore the challenge for the Fed. That, it was a week of comments. Obviously we had Powell last weekend, but then Neil Kashkari, who used to be the arch dove, and now has transformed into a hawk. He was saying, I think rates have to go to 4% or so and stay there. So there seems to be a new narrative building of higher for longer. A lot of people, a lot of strategists were quick to come out and call the end of forward guidance. But from my reading of it, there's certainly plenty of forward guidance coming from the Fed at the moment saying higher for longer. And but equally, every time you get kind of a weaker inflation print, the market jumps on that and pushes down yields again. So it's a bit of a seesaw, but certainly, as I say, noteworthy that kind of peak hawkishness hasn't arrived yet, I would say.
Yeah, and actually, another force, so to speak, that took the gas out of the market yesterday, literally speaking, was Russia.
Yes.
They turned off the gas finally now on Nord Stream 1. So for an undefined period. And so literally there should be no Russian gas flowing into Europe from now on. So we'll see what that does to markets when they reopen and reassess that. Since we're just talking a couple of days after month end of August, I think it's probably more appropriate to talk about August numbers in general, not so much what happened this week, et cetera, et cetera. And it is interesting because I think August may show quite a lot of dispersion in returns among managers. Higher than usual is my guess. I've only seen some early indications, but that's my guess. Maybe because of the counter-trend rallies we saw both in bonds and stocks, and also all the volatility we saw in other markets such as energies and grains. I think the response to these moves may be different manager by manager. And that's obviously determined by speed of models, the markets traded in the portfolio. So it'll be interesting to see how various models and managers handle the last few weeks. Of course, I mean, it looks like for sure that managers would have done well, and certainly those who had stayed short fixed income. And this is, of course, probably something I think you and I talked about briefly last time you were on, because there was this, to be perfectly frank, silly article on Bloomberg where JP Morgan and Nomura was out saying how CTAs had, I can't remember the headline, some kind of sensational headline. Obviously, that's probably not their fault. That's the journalist, given up on $100 billion worth of inflation bets, and how they had flipped their fixed income position from short to long, and how they were responsible for the rally in equities that had started in mid-June. And I think for a lot of reasons that we talked about back then, that there was just not a lot of substance or truth to that. So anyway, we'll see how that all pans out. I imagine that managers have done well, in particular from being short fixed income. I think they have done well from the currencies. They behaved reasonably well. Of course, we're down to this fact that even exposure to single markets like European natural gas, maybe even electricity for those managers who trade that can even have a meaningful impact because of the huge volatility we see at the moment. So it'll be interesting to see how the numbers pan out. I want to provide the numbers, and I want to hear your sort of assessment, putting on your old allocator hat maybe or something like that. But just so people know, my trend barometer actually finished at a completely neutral level, or in the high 40s. At the end of the month, it's at 48 at close of business Friday. So it's not indicating one way or the other, and that's also why I think we could see some dispersion depending on the factors I just mentioned. But what it looks like is that the month of August finished up 1.73% for the BTOP 50 index, meaning it's still up almost 15% for the year. SocGen CTA index up 3.33% in August, up 21.36 so far this year. Trend index did better, up 4.06%, and now up 28.29% in year to date. And finally, the SocGen short-term traders index up 0.67% for the month, up 11% and change for the year. In contrast, the MSCI World Index was down 4.33%, now down 18.7% for the year. S&P Total Return, very similar for the month, down 4.25%, down 17% for the year. And the World Government Bond Index is minus 3.14% for the month of August. I think it's only had like one positive month, and that was July. So far this year, it's really been beaten. And I think actually you probably will be able to confirm this, Alan. I think I saw some tweets now that officially we now have the first bear market in bonds, US bonds I'm talking about here, since forever. I think officially they went below a drop of 20%.
I saw that tweet as well.
Week.
I mean,
Yes.
I can't recall what index was being used, but yeah, that was
probably
it, yeah.
Barclays aggregate, something like that. But anyways, there's no doubt, and I'm sure people who have large exposures to bonds will have felt the bear, so to speak, this year. But anyways, your thoughts on August, if you have some.
Yeah, I think you're right. I think you'll definitely see some pretty wide dispersion, as you say. The nature of the moves we saw in August, with particularly, I would say, with bonds and equities. Obviously, we'd had a summer rally in both, basically, since the 14th of June. And when we were talking about that the last time, we were a bit skeptical. I mean, that said, obviously, faster systems, for some managers would have trimmed shorts, and for some managers probably would have turned, particularly in equities. If you had a breakout system, you could see how possibly you might have, with the rally in the S&P kind of by the middle of August, it was kind of hitting I guess it was 2-3 month highs. So you could see how for some managers, depending on how fast or slow you are, you might have either pared back quite a bit of the exposure or conceivably turned. But overall, it's still a very positive environment. Dollar yen piercing 140 yesterday for the first time since 1998 or so. So still very notable trends, I would say, in currencies in particular. Mixed, obviously on the commodity side, a bit more mixed. It's been kind of a grinding move down in oil. And again, you could see divergences in positioning there. It's been a bit more pronounced in some markets like gasoline, but equally it's been kind of choppy in the grain. So I think it is, certainly there's, on the currency side, some very strong moves there that I would expect managers universally would have done well from. But I could see that why you would definitely have fairly high dispersion. Obviously, we're only starting to see the numbers coming through on the kind of private placement side, but looking at US mutual fund performance over the last month, you certainly do see that that pretty large dispersion. So I think that's not surprising given what we've seen in markets.
Yeah, very true. By the way, just one comment to the equity exposure and performance. I think you're right. If you were in isolation just looking at the S&P, I think, yeah, okay, maybe some models would have flipped. My point is that when you look at equity exposure in general, certainly if I look inside our model, it is very mixed. I mean, there's some markets where we've been short for a while and some markets where we're still long.
Yeah.
So trying to give this impression that everything in your equity sector has sort of flipped or whatever.
No, for sure.
I think this is where some of these firms that came out are wrong. And also maybe just to add one more comment on that, and that is, I mean, whenever you hear people say that, in particular, trend followers should be behind a big bear market rally. Okay, if we are talking about risk management where positions get reduced for various reasons, sure. But clearly, we're not going to get any new buy signals when the market is close to its low. That's just not how trend following works.
Of course not. Yeah.
So this is what I was
absolutely. And to be
annoyed
honest,
about.
This was always, when I was on the allocating side, it was always a bugbear. You would see these articles where strategists on the sell side, I'm not sure how they've calibrated their models to try and replicate positioning, but they do seem to be far more sensitive to markets than you see in the actual positioning for large trend followers. That would be kind of my general observation, that medium-term trend following is much slower than what you typically see reported from. There's a couple of high-profile strategists that report on this fairly regularly, and there was often a disconnect between what was being suggested and what we were seeing. So I do agree with you.
Yeah, I mean, I think unfortunately, some of these analysts may actually be able to peek inside the positioning of their clients, which obviously I'm not in favor of, that you basically, even though it's anonymous, but disclosing what your clients are doing, what you're seeing, shouldn't really be allowed within these investment banks. Anyways, be that as it may, no grinds here, of course. We're all positive and happy. It's Saturday and the sun is shining. But let's move on, because we've got some good, juicy stuff to dig our teeth in. The first thing is actually something that I've spoken to both with Jerry. I've spoken to Mark about it. I don't think I've spoken to Rich about it, but I still want to hear maybe your 2 cents on Cliff Asness' article. And we're really only going to spend 3 minutes. If people say, oh no, they're not going to bring that up again. No. But Alan, we have to remember, Alan comes from a different side of this industry. He comes from the allocator side, while the rest of us come from the manager side. So I was curious about sort of the article from your perspective, if you have any thoughts. As you know, and as Cliff very kindly acknowledged on Twitter, we don't all have to agree on this, and there's a few things that I don't agree with. I still think it was a great article. It touches on a point that I think is really important, and that many of us who are pure trend followers have experienced. Anyways, enough from me. What are your thoughts?
Yeah, I agree. I thought there was a lot of very interesting stuff in it, very, very well argued. I think, when I read it, I was a bit like, I'm not sure I fully agree with all of that as well. But I think a lot of it comes down to perceptions and language as well. Even, at the outset, he talks about the raison d'etre for managed futures. And people use the term managed futures. And very often, they're kind of implicitly talking about trend following, even though they're not, even though it's managed futures reflects a whole range of different strategies: short-term, discretionary, macro, quant macro, commodity specialists, FX specialists. So it's anybody who's trading a managed portfolio in the futures market falls into managed futures. So managed futures doesn't necessarily have that mandate, but that's a bit of a minor point, because a lot of people will understand that managed futures and trend following, it tends to be used interchangeably. I think, again, the mandate, I think that was maybe a little strong to call it a mandate. It's if I would say agree with, I think what was your comment with Mark, at least more of a feature, but again, it comes back to how it's positioned, how it's being sold, and I think that's important too. But there are a lot of features of managed futures. Is positive performance in equity bear markets, is that also part of the mandate? People hadn't talked about that before, but maybe now going forward. Positive performance in inflationary periods, is that part of the mandate? I think, again, that's another feature you would expect, but not necessarily part of the mandate. And then, if it really is part of the mandate, you could actually lean more heavily on that side of the mandate, and have more risk-off characteristics in your portfolio. If that truly is part of the mandate, would you trade equities faster to make sure that you're turning quickly when equities is turning down? We've talked about kind of capped equity beta programs as well on the podcast before. There are those types of strategies out there, programs out there that either don't trade equities or cap the equity beta, or to cap the nominal exposure. So again, I think there's different Well, all of this reflects is there's different philosophies and different ideologies on this. You have some people who are pure trend followers. There are other people who believe trend following works, but it's one of a number of things that work. So we're going to combine trends in trend following with other strategies. And there's people who are agnostic. They might have a machine learning approach and they let it run. And at times it'll behave like a trend following program, and at times it won't. So from an allocator's perspective, I would say the key thing is just understand what you're buying and understand how it's presented. And we talked a few months ago about behavioral biases and narratives. And I think that's very important here. When you see positive performance, what's the narrative around it? Is it, it could be that you just have more of an equity or a bond beta, but they might be positioned differently. So I think that's the important point that Cliff is getting at in the piece, is that you really have to delve in and understand, if you're evaluating a trend following manager, if you just look at performance, well, that's pretty naive. So then you have to look at risk adjusted performance. Then you have to look at risk adjusted performance plus the pattern of performance. How are they performing in equity bear markets? Then you have to look at are they performing better in prolonged equity markets versus short equity decline? So it's kind of like going beyond first level thinking to second level and delving into it. So I think that was the big thing that I took away as a positive, that it does highlight the need for that very often, you'll have seen it over the years as well. A manager will be top of the charts for a number of years, and there'll be a narrative around it. But you really have to do your research to understand, well, are they just picking up some beta? Have they really done something differently? And if they have, well, how will that play out in a different market environment going forward? So I think from an allocator's perspective, that's the big thing. The other thing as well, I know you talked to Jerry last week and it came up about, I think it was Aspect making some modifications, and that Jerry wasn't impressed with that. But I think, obviously, managers are in the investment management business of providing products and different strategies and different options to their clients. So I think you have to be cognizant that, you're solving for different investor utilities as well. So if you have a pure trend portfolio, that might not be what everybody wants. That people may prefer combining trend with a non-trend system like carry. You might have a lower drawdown over time. So it's not just about saying, no, trend is the best and that's the only thing you should do. There are the behavioral biases on the side of the investors, that it can be hard to stick with a pure trend following program through a prolonged drawdown. Whereas if you have a multi-strat, yes, it might shave some of the performance in those severe equity downturns, but that could enable the investor to stay invested in the strategy over the longer term, which could be a good thing. So I would say, don't be too hard on investors on managers for providing different options. And the point is, a lot of the big firms will have a pure trend system, or depending on how you define pure trend, and a diversified system. So it's really up to the investors to do their homework to understand what's in it and make their own choices.
Yeah, no, I think that's perfectly fair. Well said, and you're absolutely right. I was absolutely somewhat surprised by the response that I got from Jerry when I brought this up last week. Still feel a little bit sorry about that, but nothing I can do about it. But it's interesting because it kind of reminds me of the title of a book that I co-authored with Harry, where we called it The Many Flavors of Trend Following, because that's exactly what there is. There are many flavors of trend following. So we kind of anticipated that quite a few years ago when we wrote the book. But what I will say, there are two things that this paper did. The good thing is, I actually think Jerry has a point in saying, well, maybe we need to distinguish between managed futures and trend following. I actually think that is a good point, because unfortunately, I do think that people, when they hear the word managed futures, they still think trend following. So maybe it's a good thing we do. The bad thing is that it's now given Jerry an idea of a new term, namely mismanaged futures. And I know he's listening to us speaking. And all I will say is that I don't think it's a good idea to try and promote that, even though it fits maybe his narrative, because if that narrative gets heard by the wrong people and they don't understand what it's meant by, then it could actually be interpreted as something like, I don't really like anything to do with managed futures. because there's something going on here that shouldn't be going on. So I don't actually subscribe to that as a good idea, but of course I know exactly why it might appeal to Jerry. But anyways,
if I just want one final point on this, which I think again comes back to the point of knowing what you're getting, because in the Cliff Asness piece, he talks about how AQR have embraced economic trend following as well, which is interesting. And some purists might dispute whether that's part of trend following. The whole philosophy of it, you should just focus on the price. But if you think about how a lot of trend following managers have evolved their systems, you either traded more markets or you added diversifying strategies, and some of them are things like carry, which Cliff Asness pointed out, but in other cases it were things like quant macro. So economic trend following might be slightly different, but it would still be in the broad category of using more economic data to inform your process. Now again, you have to really delve in to understand, well, what is the nature of that system? Is it relative value, or is it directional? In some cases we saw some quant macro strategies struggling in, say, the COVID period, because obviously price was much quicker to respond to what was evolving as opposed to economic data. So I'm not saying what they're doing is in any way not a good thing, but again, it's a matter of understanding precisely what you're getting when you're allocating to a manager, and that's really where you have to do the homework as an allocator.
Absolutely. I will say, though, that from the level of understanding that I have, I don't think it's a good idea to now try and put quant macro into something and then label it as trend following. I think we as trend followers, we need to stick with the fact that we use price. Once you start to add all these other things, then I think it's different. So I'm a little bit worried about that.
I mean, I guess it comes back to
my personal
preference.
Back
to labels again. You can have quant macro, you could have economic trend following.
Well, we have systematic global macro, and that was that's
the same quant macro, systematic global macro.
And that was very, very popular. And if you remember, it was so popular because it didn't use the word trend following, it didn't use the word managed futures. So a lot of investors flocked that way. But as you rightly point out, when markets started to move quickly in 2020, many of these quote-unquote systematic global macro funds that had enjoyed massive amounts of inflows in AUM, they did not do well, and some of them even had to close shop. So this is why I mean that there's a risk for us as pure trend followers to get a bad rap because people start blending other things in that investors think that's more or less the same. It sounds more fancy, so I'm going to do that, and then they have a bad experience. But, these things happen from time to time. I do remember back in 1994 where, again, futures had a really bad reputation, and I saw many of our CTA friends started to call themselves hedge funds until hedge funds got a bad rap, and then they were CTAs again. So we understand fully why these things are happening. Anyways, we want to move on to another paper that you wanted to talk a little bit about. I have briefly read it. It's from our friends at Quantica, came out. And that's not about them, really. It's about trend following as a strategy, which I really like about the paper, and how it fits into an overall portfolio. It's kind of like an updated version of the all portfolios needs trends that Alex Grayson wrote many years ago. He used 1 million different portfolios. They're using 10,000 different portfolios, but I think the message is pretty much the same. So I want to let you talk about this.
Yeah, it's funny that Alex Grayson's paper came to mind as I was reading it. I was trying to think, do I still have that, or was it exactly the same message? But it is very much a paper on the benefits of trend following and what it can add to a multi-asset portfolio, and that might sound like something that has been covered before, but what was different about this paper was they take 9 assets that they feel are kind of representative in lots of different institutional portfolios. You have developed market equities, emerging market equities, NASDAQ, and then property, investment grade bonds, high yield bonds, emerging market debt, commodities, and gold. And rather than defining the benefit of adding trend to a 60-40 portfolio, which is kind of the typical approach you see in these kinds of papers, what they do is they randomly combine, or they look at all of the different permutations of the different combinations of those 9 portfolios. So you can obviously have 100% exposure to equities or developed market equities, 100% exposure to gold or commodities, or 100% to emerging market debt, and then the different kind of multi-asset mixes that you would get by combining all of the different 9 portfolios. And they basically generate 10,000 hypothetical portfolios historically, and then go back and look at how much, if you were to optimize those portfolios by combining an element of trend, what would be the optimal allocation to trend going back basically over the last 20 years, I think, going back to when they use the SocGen trend index. And I mean, I suppose that the first headline is the average allocation to trend is 40%, and that's in terms of just sharp maximization. So it could mean a lower return, but that's how they define it in sharp maximizing. Adding trend would have improved the Sharpe of all of the 10,000 hypothetical portfolios. So that's another.
That's quite interesting, isn't it?
So I guess if you were to put it in context, if you had a portfolio, say, of emerging market bonds and gold over the last 20 years, you could still have improved that by adding trend. Or if you had a portfolio of, say, emerging market equities, emerging market bonds, and high yield bonds, you could have improved that as well by adding trend. Or if you had a 100% equity portfolio, and if you had a trend to that, you would have improved the Sharpe. So no matter what mix of any of those 9 assets, if you had added trend to it over the last 20 odd years, you would have improved the Sharpe.
And can I just add one thing, because I think it is relevant, and that is, as you rightly say, they're using the SocGen Trend Index, which started in January of 2000, so it's about 22 years that this period is covering. But actually, those 22 years, and I can say that with some level of confidence because our track record is 48 years, right? So those 22 years were certainly not the best for trend following, right? It is through this environment where, rightly or wrongly, trend following has been somewhat more challenged, at least. So this is also adding, in my opinion, adding to the importance of this message.
Yeah, for sure. I would have said the first 10 years was probably, I remember looking at this before in a historical context, that 2000, 2010 was, it did have a lot in it that was good for trend following. Obviously, you had 2 equity bear markets and the commodity super cycle. But then obviously the last 10 years was a very difficult period, a more difficult period for trend following. Some of their, high level takeaways, the improvement in Sharpe ratio on average was 0.16. So I think it was from 0.51 to 0.67. They then also looked at, if you looked at 5-year periods, so not just saying, okay, let's take a 20-year view, because, if you take a 20-year view, it's like finance 101. Why wouldn't you allocate to trend following? It's like you get a positive return in equities, you get a positive return in trend following with a negative correlated. So, you'd wonder why there is a debate at all. But then I suppose the point is, when you look at the 5-year rolling periods, yes, there are periods when you wouldn't have had an allocation to trend following for some of the portfolios, and that's obviously you touched on the fact that we've had some tough periods. So I think I actually ran it myself, but I don't have it in front of me. If you were to look at a 5-year rolling Sharpe ratio of the SocGen Trend Index, the 5 years to the end of 2013, or certainly the halfway point of 2014, would have been negative as far as I can recall, and the 5 years to the end of 2019 was a tough period as well. So in those periods, you wouldn't have had for some of the portfolios, not all, it was only a small percentage of the portfolios wouldn't have had an allocation to trend. But the point that they make two interesting points here. One is that, well, there were periods where the portfolio did well anyway. And secondly, particularly say the 5 years to the end of 2019 was very strong for bond and equity beta. So if you'd had allocated a trend, your overall portfolio would still have done very well. And by allocating to trend, it wouldn't have detracted a whole lot anyway. But the periods when trend following adds value, obviously, is when you need it most. So, and again, that's what we're seeing this year as well. So I think it's an important message that even, you don't know what the next 5 years are going to look like. It could be a good period for trend following. It could be a bad period. We don't know. But certainly from a robustness perspective, you'd have to say it makes sense to have this in there, because if it turns out to be a terrible 5-year period going forward for traditional assets, trend following you would expect to do well based on history. No guarantees, but based on history. If it turns out to be a great 5-year period for equities, well, great. That your portfolio will do well anyway. So that's kind of the message there. The other point, that the final bit that they did, which was interesting, is they basically, I suppose you might call it a stress test or a sensitivity test. They said, well, would these results still hold if you started to reduce the return from trend following? So if you start knocking 1%, 2%, 3% off, the return from trend following, going back to 2000, the stock exchange trend has annualized, I think, a little bit over 6%, 6.3% in inception is what they say. So if it was down, to 5% or 4%, and they basically find that it still would make sense. Historically, it would have enhanced Sharpe ratios, even if I think it's down to 3% anyway, but the returns from trend following would have to get down below 2% for it not to be something. And of course, that's in the context of those historical returns of those asset classes. So they've taken the historical returns, say, for high yield bonds, investment grade bonds, over the last 20 years. And obviously those were, maybe inflated is the wrong word, but they reflected the fact that the starting
Above
yields
average,
for those assets were high back in 2000. So you would have to then adjust for that if you were doing a forward-looking analysis to reflect the fact that yields are obviously lower now than they were 20 years ago again. So again, an interesting take on something that, most managers in the industry have produce something like this, I would say, at some point in time, but this is slightly different and interesting from that perspective.
Yeah, no, absolutely. I also think it was a great paper, and I really did like actually that analysis where you start every 6 months with a new 5-year period, and just to see how few periods actually where it wouldn't have selected a trend following allocation. It's remarkably few. So I completely agree with their conclusions of the robustness and the benefits and all of that good stuff in terms of allocating to trend following, which of course begs the question, even after 30 plus years of doing this, is why do people still not have an allocation to trend following? And if they do, why is it not meaningful? But anyways, that is how the world is at the moment. Now we're going to take a big jump all the way to Wyoming because you have some key takeaways from Jackson Hole, of course, the place where central banks meet once a year, do some fly fishing, and then they talk about the economy. We, of course, already know that Chairman Powell came out with a hawkish speech, but you want to talk about some of the other things that came out of the central bank conference, or whatever we call it, symposium, I think is what they call it themselves. So I'm excited to follow your lead.
Yeah, I thought it was obviously very market moving, Powell's comments, and a few things that really struck me. One, very similar messages, not if you just read Powell's speech, but across a number of the different speakers, and bankers, economists, etc., all with very similar messaging, which I would summarize as, we've got a situation where aggregate supply is going to be less responsive over time, and that has implications for how you manage monetary policy, and those implications are not favourable. So, we had a favourable aggregate supply shift over the last 2-3 decades, where you could basically run the economy pretty hot and always put in a lot of stimulus without ever having to worry about generating inflation. That seems to be over now. The interesting thing about Powell was his kind of reference to history, and this is the other thing that really the 70s 80s period is really weighing on all of central bankers' minds, and you really feel that when you go through all the speeches. His comment was peppered with historical references, and he cites Bernanke, Greenspan, Volcker, all of their kind of comments on inflation, and he literally says the lessons from history. And then the other speech that was really interesting was from Isabel Schnabel, who's a member of the executive board of the European Central Bank, and it has a very very striking title, and that basically it's, are we going into a great volatility? Obviously, we all know the expression "the great moderation," which economists talked about for years. But striking that a member of the ECB executive board would be talking about, will the next 5 years be the great volatility? And again, her overall topic and tone was very similar in the sense of, she says we may have potentially more larger, more persistent shocks over time. Globalization, deglobalization is one of the main things. The fact that the energy supply is not as elastic as it once was. So this is something that nobody ever talked about for a long time, because obviously it wasn't a problem. You had shale in the US. If you go back to maybe 2005, 2006, everybody was talking about peak oil and what a problem this is going to be. And then it kind of went away because obviously you had the shale revolution. But it's back now, this concern about the limits for aggregate supply. She talks about how supply chains will be become more robust because they'll be brought back to the domestic market. But that means duplication and inefficiency. So again, not a positive message. But where she comes at is that these shocks imply a trade-off for monetary policy. And it's an unfavorable trade-off between inflation and unemployment. So this is something that we were talking about a few months back, how this is going to come back, that basically, central bankers have a fairly unpalatable decision at the moment. You either raise rates and slow the economy, which means higher unemployment. Nobody likes that. Or else you kind of have to sit tight and let inflation stay high and possibly lose your credibility. So it's a very unfavorable trade-off. So the overall message here is, that again, Isabel Schnabel draws from history and talks about the lesson is you basically have to err on the side of being more aggressive now. And I mean, putting that bluntly, that probably means a recession, and it means higher unemployment, and just having to accept that. But it's been framed from the perspective that if you don't do that, that the bigger cost is that you would have to do it later, and that would be more painful. So I think this is, and that's the same message as you got from Jay Powell. He talked about pain for the first time, and I thought that was interesting because if you go back to the last press conference in July, he kind of danced around that issue a bit. He talked about slack in the labour market. What does that mean? It sounds like a loose economist's expression, but no, what it means is people losing their jobs and having higher unemployment. So I think the central bankers are becoming more forceful, more blunt with their messaging, and the market is only waking up to it. But certainly. Interesting that you had a central banker saying what all of this might mean is more forceful policy in the short term, and a recession, and then presumably if they're successful, then maybe they would have to unwind that, and that's where you might have this volatile period that Isabel Schnabel is talking about. But I think it was something that Yeah, it was very blunt and very striking from that perspective.
Yeah, I mean, it's always good to get some plain speak from some of these people, right? But what I'm just curious about, I don't really have any sort of comments to what they said, but my query is more, well, if they're so blunt now, if they're so sure that they need to be forceful now, what took them so long, right? I mean, it's like she's talking about this as, well, it's in the history book, so we all knew it. But why haven't they done it? I mean, the ECB, what did they move from negative to flat? So is that being aggressive? Not in my book. But anyways, we'll see. Of course, from the great moderation to great volatility is something that I think a lot of us, in other words, have been expecting for a while. It's playing out right now, and it's probably nowhere near coming to an end. Which is why, of course, we believe that these divergent strategies that we represent should continue to have much more favorable conditions compared to the last 20 years or so.
Yeah, it's interesting. But, I mean, if I just jump in on that, because I had the same thought reading the speech, because within it, Isabel Schnabel talks about how one of the economists that she references, a guy called Carl Walsh, who's basically saying that when you get this kind of shock, central banks should conduct monetary policy assuming that inflation is persistent, which is pretty much the opposite of what has been done. Because if you go back a year, it was conducted on the assumption that it was transitory. So it's as if they've kind of gone back and looked at all the research on this. That actually, what we should have done here was to assume it was persistent, but actually we assumed it was transitory. So
actually Powell still used the word transitory in his speech, which I'm surprised that he even dared bring up again. But anyway, let's leave the central bankers for a second, because actually what we're going to talk about is the bank for central bankers, the BIS, Bank of International Settlements, because they were also out with some commentary talking about the challenges ahead.
Yeah.
So I don't know if you feel you already talked about that, but otherwise,
it's very similar. This is from Augustin Carstens, who's the general manager of the BIS. But I guess it's just interesting. Again, the BIS has been writing lots of stuff over the years about, that has probably been a bit more pessimistic than mainstream central bankers. For a long time they'd been writing about the possible unforeseen consequences of keeping rates very low. But now it's just interesting. His whole speech was in a similar vein as Schnabel's about this change in the supply side dynamics. And a couple of things were highlighted. Basically, it's the similar kind of factors, that a number of structural factors supported inflation over the last 2 to 3 decades. Globalization, obviously, bringing China and Eastern Europe into the global labor force, technological developments, demographics, and obviously globalization, sense of free trade and all of that as well. And then again, basically just looking at all of these factors one by one and saying, well, factors that had been tailwinds for inflation, as in which have been disinflationary forces, were now going to be headwinds for inflation. But he had an interesting expression. It's called. He used an expression that comes from aviation, where the economy may be approaching what is called a coffin corner. I haven't heard this before. You might be more of an aviation.
Doesn't sound good in aviation.
It's the delicate spot where an aircraft slows to below its stall speed. So it's basically that because of these supply constraints, the economy could stall out, and just nosedive, I guess, is the kind of the graphic that comes to mind. So very pessimistic, and it kind of made me think. For years, it's all been about central bank demand management, but we could be moving forward hearing a lot more about supply side measures, that we used to hear back in the 80s and 90s about getting the supply side of the economy more flexible, because that was the only way to promote growth in the longer term. So that was interesting how all of the central bankers and policymakers seem to be saying we've got this much bigger constraint from supply now, and that makes it much more difficult to do demand management policies, which is what central bankers do. And from the BIS, it's very much a clear message of you won't be able to do that going forward, and policy should be directed at improving the supply side.
Since you love this central bank stuff, Alan, you should really reach out to William White, who used to run the BIS, and ask him on your allocator series, because actually I've heard him speak elsewhere, and he's a brilliant man to talk about these things and actually how central bank policies is in fact conducted. And I think people will realize that it's very different from the calm and collective and well thought out that maybe some people think they always know exactly what to do. So anyways, if anybody has his ear of our listeners, maybe they can
for sure. Yeah, no, I've read
some
of his pieces over the years, and it's been exactly that.
Yeah. Absolutely. Well, we're not going to leave completely the central bank world just yet, because another topic that you wanted to touch on is this thing that also happened in Wyoming, and that is where they were talking about reassessing the 2% inflation target. And by the way, I don't know if you know, but do you know where the 2% inflation target came from?
Well, it was the Reserve Bank of New Zealand that brought it in first. I don't know what their rationale was.
Actually, true. From what I could find out, actually, this was a loose comment that a former finance minister in New Zealand put out when he was doing a TV interview back in 1988.
Yeah.
So it doesn't seem like it was something that was well thought out.
No.
But it did become adopted by pretty much many Western central banks. So that's just. But you're right. It's we can blame the Kiwis, not that we would, of course, for this. Anyways. Are they gonna leave the 2% inflation target, or what are they?
Yeah, it's just interesting.
Saying?
I'd written a piece a couple of months ago on this, saying I think this is something that will come onto the agenda for markets much more over the next few months. I'm surprised it hasn't got more coverage to date. Paul Krugman wrote a piece about this probably 2 months ago, and he's and he touched on exactly your point that the 2% was kind of pulled out of a hat. There was no kind of science to it. What is price stability? That's the whole point. Should it be 2%? Should it be 1.5? Doesn't matter. But if you go back 12 years after the global financial crisis, the 2% did prove to be problematic, because obviously central bankers were aiming for 2%, and inflation then kind of settled a little bit below that. And then if you bring interest rates to zero, you couldn't get very negative real interest rates. You could only get marginally negative real interest rates. Whereas if you had a higher inflation target, like say 4%, then you could get at least meaningfully negative real interest rates without having to push nominal interest rates below zero. Now, obviously, we did go below zero for nominal rates, but economists or central banks were reluctant to do that generally, because might have various unforeseen side effects, I guess. But the Olivier Blanchard, who was the chief economist at the IMF, I think at the time, he wrote a piece saying maybe look at 4%. So kind of went away at the time, but I think it could come back now. Well, it has come back by this FT article. Colby Smith was the journalist who wrote it, and basically saying, that this is something that came up an awful lot. It wasn't so much mentioned in the speeches, so I'm guessing it was kind of in a lot of the chit-chat that went on there, or maybe in some of the Q&A. But certainly that economists and central bankers are reassessing whether 2% is still relevant, still the right rate to be shooting for, or whether it needs to be adapted, as the article says, for a more fractured global economy. Now, the problem is, obviously, if it's like moving the goalposts at the worst possible time, because from a credibility perspective, you won't want to do it. But I think where it really gets interesting, the Fed may be successful in getting inflation down to 5%, 4%. If you can get it down to 3%, you'd probably think they would be happy with that. And then, if getting inflation down another 1 or 2% is going to cause a spike in unemployment, does it make sense? What's the economic rationale? All of that. So I think that's going to come up as a topic for debate more and more. I'm surprised it hasn't got more coverage, but I think it's very interesting, and I think we will hear more of it.
Yeah, no, I think that's true. All right, well, let's round off today's episode with a couple of short topics. I don't know if they're short, but one is still related somewhat to what was going on in Wyoming, because it does include Volcker. As far as I can tell from your headline here.
I'm trying to remember what the topics I sent you now. Yes, I remember now.
Lessons from Volcker's tightening cycle, The Secrets of the Temple. And it's apparently a book.
That's right, yeah. So obviously there's been a lot of talk from the various central bankers about the lessons from history. So, I've been reading a bit more on this lately, and one that I give a shout out is a book called Secrets of the Temple by a guy called William Grider, which covers all of this kind of period in the late 70s, early 80s. So really well, it's quite a lengthy book, but I'm kind of halfway through it. Very interesting in kind of the detail it gives around the period. And a few things struck me reading it. Like when you go back to that period of the late 1970s, yes, there are parallels with today and lessons, but equally differences as well, which is important to bear in mind. You'd had a decade of inflation in the US at that point, so it was really embedded in the system. The general expectation was of 10% inflation going forward. I mean, that was a widespread belief. Also in the 70s, you had a structurally weak dollar, which I think is another very important difference between what we're seeing now. And Volcker always used to look at the dollar, and he looked at gold prices as measures of, were they being successful in terms of their credibility. So, the dollar is breaking out above 140 here. It's not that kind of really pessimistic situation in the US that you had back then. And equally, gold has gone up in euro terms, in yen terms, but not in dollar terms this year. So again, it's slightly different. And the other area is that when you read about the period, it was a period where there was this rampant speculation in commodities. They talk about, obviously, 1980 was the year where the Hunt brothers tried to corner the silver market, and they talk about that as well. But equally, there was a general sense of borrowing to consume because prices were going to go up, and it made sense to have debt because the real value of debt would be eroded over time. So I think it's interesting when you look back at this period of the late 60s, the 70s, the 80s, people just kind of broad brush and say, the 70s inflation, and this is what happened. Actually, you had probably three distinct periods. You had like late 1960s, early 70s. You had another period around 1973, 74, and then another inflationary surge in 1979, 1980. And by the end of the decade, it was much more credit driven rather than what we're seeing at the moment, which is a strong economy coupled with a supply shock. So very interesting when you delve into it. The other point that I think was interesting too is people talk about how Volcker, he was successful in kind of shifting the dynamic. But even then, even in 1979, when they made the first change, and it wasn't to raise interest rates, it was to basically go to target the money supply, and the side effect of that would be higher interest rates. But one of the reasons they did that was because they didn't believe they had the political cover to actually raise rates as much as they needed to. So they said, well, what we'll do is we'll announce that we're going to target the money supply, and the knock-on effect of that will be higher rates, but we'll be able to say, well, it's not really our problem, we're targeting the money supply. So it's just interesting how even the guy who's kind of heralded as the one who saved the US economy by fighting inflation, it was probably had to engineer tactically how he would get his own FOMC on side, and obviously at the time was probably fortunate that in the White House Carter didn't really have the political clout to kind of go against it. So I just think that everybody's saying, Powell, he's kind of going to be like Volcker and will follow through. But I just wonder, as it gets more painful, will the political pressure come on, and will that be an important dynamic? And certainly when you look back, you can see how that could play out. So yeah, I just wanted to give that a shout out in case anybody's looking for sources on that period.
Yeah, no, thanks for that. And I think that there are a couple of interesting things in that. First of all, I think the first takeaway from me is that even back then, clearly narratives were very important, right? We talk about narratives today being important as if it's something new. Clearly, it's not. Secondly, of course, is the fact that it's true. And as I talked to Jem about a couple of weeks back on the Wednesday episode. Clearly everybody talks about Volcker, but let's not forget that actually Arthur Burns, he did raise interest rates quite significantly, but his timing was a little bit early, and just sometimes you don't get the result you expect because of that, let alone the fact that there was this political backdrop against what they were doing. So anyways, super interesting, and it is not surprising, but it is, in lack of a better word, interesting how they have been pulling out all these references back from the 70s in the latest narrative that we're getting now from central banks. And I can't remember what he ended his speech with, but it's something like, they're not going to be done until the job is done. Or whatever.
That was the other point. It was reference to sticking
quote.
With it, which I think is the name of Volcker's
Volcker's book
biography.
exactly.
Yeah, so it is that, and actually that's what happened in 1980. In 79, early 80, they tightened, but then they eased, and then inflation took off again. So that's the lesson that really has been harnessed, I guess.
Forward now, absolutely. Final topic, which also sounds interesting. I have no idea what's in it, but it is kind of the latest you've picked up from a great investor, Jeremy Grantham. I have not read it, so I don't know what's in it, but I will listen carefully.
Yeah, well, Jeremy Grantham has just updated, I guess, his super bubble hypothesis viewpoint. I guess people are familiar with Jeremy Grantham's writings. He wrote, I think it was probably in 2020, about the last dance, that the equity market was, going, it might have one final rally up, and then, towards, I think it was the end of last year, start of this year, was, you'd have to say, fairly good in timing that it looked like we were entering this period. I mean, now it's an update basically saying what we've seen in the last, during the summer, the rebound is an equity bear market rally. So nothing massively new, I would say, except for highlighting that, maybe when he'd written his previous pieces, it was just based on maybe more of a statistical observation that when you get a 3 sigma deviation from trend in equities, that inevitably it will revert back to trend, and that often means I think he quotes a 50% decline in equities. He says the difference now is actually his read on the fundamentals is that the fundamentals are obviously showing much more worrying trends in terms of food prices, fertilizer prices, China's economic trajectory, going from fiscal expansion to fiscal tightening in the US, coupled with the longer term climate change, demographics, stuff that he's talked about before. So kind of an interesting fundamental overlay to his long-held view that what we saw up through 2020 was a super bubble across not just equities but across a number of asset classes, and you had that speculative frenzy, particularly in the start of 2020, that was symbolic of that kind of bubble market. So we were talking about this actually the last time, how managed futures trend following had done in that kind of equity rebound and relative to past episodes, within equity bear market. So this one is probably, if we have seen a high, it's hard, who knows, it's either the start of a new leg up or it is an equity bear market rally. If it's the latter, it's probably 2 months or so, I don't know, probably on the short side, I would guess, relative to history, but certainly that's his viewpoint. And again, really at the core of his view is a lot of what you're hearing from central bankers as well. These supply side challenges are really coming home to bite now for the economy and for markets.
Yeah, no, absolutely. And of course, as we all know, we're probably facing maybe the most difficult time ahead of us, namely what happens when you go through a winter without enough gas and electricity, and what does that do to companies. And we already know that many countries have now put in restrictions in terms of how much or how high you can put the temperature in the offices and maybe even at home and all of that. And since this is not something we've seen in our lifetime, I vaguely remember the not driving on a Sunday during the last oil crisis in the 70s. Of course, I didn't have a driver's license back then, so it didn't really matter. But there's going to be some challenges ahead, without a doubt, and we'll obviously be here to do our best to guide people through that. Good. Well, as always, Alan, I really do appreciate all the preparations you put into this. Thoroughly enjoyed our conversation, as I'm sure and hope our audience have done. And of course, if you did, why not jump over to Spotify and iTunes and tell the world that actually they should go and check out this little podcast. Next week, I'm joined by Rich. He's going to be back probably with some hardcore trend-following themes, the latest and greatest from him. So if you have any questions for Rich to dive into, do send them early as possible to info@toptradersunplugged.com, and I'll do my best to bring them up with Rich. That's it for now. From Alan and me, thanks so much for listening. We look forward to being back with you next week. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.